Hey everyone, welcome to Success Insights. Have you ever wondered why some people get approved for loans easily while others get rejected? Or why your friend pays way less interest on their car loan than you do? The answer is something called a credit score. And today, I'm going to explain exactly what it is, why it matters to your wallet, and how it can either save you or cost you thousands of dollars. Let's dive in. So, what exactly is a credit score? Think of a credit score like a report card for your money habits. Just like in school where you get grades that show how well you're doing in your classes. A credit score is a number that shows how responsible you are with borrowed money. Here's the simplest way to understand it. Imagine you want to borrow $100 from a friend. Your friend is thinking, will they pay me back? Can I trust them with my money? Banks and lenders think the exact same way, but instead of guessing, they look at your credit score, a 3-digit number between 300 and 850. Let me break down what these numbers mean. 800 to 850, you're a superstar with money. Banks love you. 740 to 799, you're really good with money. You'll get great deals. 670 to 739, you're doing okay, pretty average. 580 to 669, you need some improvement, red flag territory. Below 580, you're struggling and banks are very nervous about lending to you. Here's the simple rule, the higher your number, the more people trust you with money. It's that simple. Think of your credit score like a trust meter. The higher the score, the more banks trust you. The more they trust you, the better deals you get. Lower interest rates, bigger loans, and more approvals. The lower the score, the less they trust you. Higher interest rates, smaller loans, and more rejections. So your credit score literally determines how expensive or how cheap borrowing money will be for you for the rest of your life. Now you're probably thinking, okay, but why should I actually care about this number? Let me show you with real examples. Let me show you how much your credit score actually costs you in real life. Example number 1. Buying a car. Let's say you want to buy a $30,000 car and you need a loan. Person A has a credit score of 780. That's excellent. Person B has a credit score of 620. That's poor. Both people want to borrow $30,000 for 5 years. Same car, same loan amount, same time period. Person A, with the excellent credit, gets an interest rate of 5%. Their monthly payment is $566. Person B, with the poor credit, gets an interest rate of 10%. Their monthly payment is $637. That's $71 more every single month, just because of a lower credit score. Over 5 years, Person B pays for $1,000 to $160 more for the exact same car. That's over $1,000 thrown away. That could be a vacation, new furniture, or savings for emergencies. Example number 2. Renting an apartment. You find your dream apartment. Perfect location, great price. You apply. The landlord checks your credit score. If you have good credit, score above 700, the landlord says, welcome. When can you move in? Easy approval, standard deposit. If you have poor credit, below 600, the landlord says, I'm taking a risk here. You need to pay an extra $1,000 security deposit. Or worse, sorry, we can't rent to you at all. That's $1,000 more just to move in, or you can't even get the apartment. All because of your credit score. Example number 3. Credit cards. With a good credit score, you get premium cards with 2% cash back on everything, no annual fee, and a low interest rate of around 15%. With a poor credit score, you get basic cards with 0 rewards, a $99 annual fee, and a sky-high interest rate of 29% or more. So not only are you paying more in fees and interest, but you're also missing out on hundreds or even thousands of dollars in cashback rewards every year. Your credit score literally affects everything: cars, apartments, credit cards, loans, even insurance rates and job applications. This is why this number is so important. Alright, so how is this magical number actually calculated? What do you need to do? Your credit score is based on 5 main things. 5 factors that banks look at to decide if you're trustworthy. Let's build a credit score together. Factor number 1, payment history. This is 35% of your score, the most important factor. This is simple. Do you pay your bills on time every single time? Think of it like showing up to work. If you always show up on time, your boss trusts you, right? If you're always late, your boss loses trust in you. It's the same with credit. If you pay your credit card bill on time every month, boom, your score goes up. If you're late by 30 days or more, bam, your score can drop by 50 to 100 points. Just like that. One late payment can stay on your credit report for 7 years. 7 years of damage from one mistake. So here's my pro tip: set up automatic payments today. Right now. Don't rely on your memory. Set it and forget it. Never miss a payment again. Factor number 2, credit utilization. This is 30% of your score. What does this mean? It's how much of your available credit you're using. Let me explain with an example. Let's say you have a credit card with a $1,000 limit. Bad scenario, you spend $900 out of that 1,000. That's 90% used. Banks see this and think, oh, this person is maxed out. They're struggling. Red flag. GOOD scenario, you spend $300 out of that 1,000. That's 30% used. Banks think, okay, they're using credit but not going crazy. Responsible. Excellent scenario, you spend only $100 out of that 1,000. That's 10% used. Banks love this. They see you as super responsible. The simple rule: try to use less than 30% of your available credit. The lower, the better. If you're using all your available credit, it looks like you're desperate for money and might not be able to pay it back. So keep those balances low, folks. Factor number 3, length of credit history. This is 15% of your score. The longer you've had credit accounts, the better. Think of it like a job resume. Someone who's had 10 years of work experience looks way more reliable than someone with only 6 months of experience, right? It's the same with credit. If you've had a credit card for 10 years and you've been managing it well, banks see that long track record and think, okay, we can trust them. They've proven themselves over time. But if you only opened your first credit card 6 months ago, banks are like, we don't know you yet. You're new, risky. So here's the key takeaway: don't close your old credit cards. Even if you don't use them anymore, keep them open. That old card from 5 or 10 years ago, it's helping your credit age. Keep it. Factor number 4, credit mix. This is 10% of your score. This means having different types of credit, like a variety pack. Credit cards, that's revolving credit. Car loans, that's an installment loan. Student loans, another installment loan. Mortgages, also installment credit. Think of it like being multi-talented. Someone who can cook, drive, and fix things is more capable than someone who can only do one thing, right? Having different types of credit shows you can handle different financial responsibilities. But, and this is important, don't rush out and get every type of credit just to boost this factor. This develops naturally over time as you need different types of loans. You don't need to force it, just be aware that variety helps. Factor number 5, new credit and hard inquiries. This is the final 10%. Every time you apply for a credit card or loan, it creates a hard inquiry on your credit report. Think about it. If someone applies for 5 credit cards in 1 month, what does that look like? It looks desperate, like they need money urgently, and that makes lenders very, very nervous. Each hard inquiry can drop your score by 5 to 10 points, and if you have too many in a short time, it looks like you're in financial trouble. The rule: only apply for credit when you really need it. Space out your applications by several months. Now, here's a good tip. If you're shopping for a car loan or mortgage, You can apply to multiple lenders within a 14 to 45-day window, and it only counts as one inquiry. So you can shop around for the best rate without hurting your score. Pretty cool, right? Okay, let's quickly recap those 5 factors. Number 1. Payment history 35%. Pay on time, always. Number 2. Credit utilization 30%. Keep it below 30%. Number 3. Credit history length 15%. Keep old accounts open. Number 4. Credit mix 10%. Have variety but don't force it. Number 5. New credit 10%. Don't apply too often. Focus on the first payment history and credit utilization. Those are 65% of your score combined. Master those and you're already way ahead. Now let me show you the biggest way your credit score affects your wallet. This is the example that blows people's minds every time. Let's say you want to buy a $300,000 house. With a 30-year mortgage, Person A has excellent credit, a score of 760 or higher. Person B has POR credit, a score between 620 and 659. Both want to buy the same house, same price, same 30 years. Person A with excellent credit gets an interest rate of 6.5%. Their monthly payment is $1,896. Over 30 years, they'll pay a total of $682,632. Person B with poor credit gets an interest rate of 8.5%. Their monthly payment is $2,307. Over 30 years, they'll pay a total of $830,520. The difference? $147,888. That's almost $150,000 more just because of a lower credit score. That's like buying a second small house with the money you'd save with good credit, or for brand, new cars, or 50 dream vacations. This is why credit scores matter so much, folks. We're not talking about saving $50. We're talking about saving enough money to change your life. This example right here is exactly why I created this channel, to teach you this stuff that nobody teaches in school. A good credit score can literally save you tens of thousands, even hundreds of thousands of dollars over your lifetime. It affects everything: your car, your apartment, your credit cards, your insurance rates, even job opportunities. So now the big question is, how do you actually build a good credit score? What actions do you take today? Let me show you. Alright, let's get into the action steps. Whether you're starting from zero or trying to improve a damaged score, here's exactly what you need to do. I'll break this into 2 sections. First, for beginners who have no credit yet. Second, for people who need to improve their existing score. Let's start with the beginners. For beginners, if you have no credit yet, here's your 5-step plan. Step 1. Get your first credit card. Start with a secured credit card or a student credit card. These are easier to get approved for when you have no history. A secured card requires a small deposit, like $100, which becomes your credit limit. Step 2. Use it for small purchases only. Don't go crazy. Buy something small like gas or groceries. Maybe $20 to $50 per month. That's it. Step 3. Pay it off in full every single month. This is crucial. Pay the full balance, not just the minimum. This builds your payment history without paying any interest. Step 4. Keep your balance low, under 30% of your limit. Remember that credit utilization factor? If your limit is $500, don't spend more than $150. Keep it low. Step 5. Be patient. Building credit takes time. You won't see a great score overnight, but after 6 to 12 months of doing this consistently, you'll have a solid credit foundation. The key word here is consistent. Do this every month without fail and your score will grow. Now, if you already have credit but need to improve your score, here are your 6 action steps. Action 1. Pay down your credit card balances fast. Focus on cards that are maxed out first. Getting your utilization below 30% can improve your score in just a few weeks. This is the fastest way to boost your score. Action 2. Set up payment reminders or automatic payments. Never miss a payment from this day forward. Seriously, set alarms, calendar alerts, or just automate it completely. Missing payments is the #1 score killer. Action 3. Don't close your old credit cards. I know I've said this already, but it's worth repeating. Even if you don't use that old card anymore, keep it open. It's helping your credit age. Just use it once every few months to keep it active, then pay it off immediately. Action 4. Check your credit report for errors. Go to annualcreditreport.com. That's the official free site. Check all free credit bureaus, Equifax, Experian, and TransUnion. Look for mistakes, wrong addresses, accounts that aren't yours, incorrect late payments. If you find errors, dispute them. Errors can wrongly hurt your score. Action 5. Become an authorized user on someone else's account. If you have a family member or close friend with excellent credit, ask them to add you as an authorized user on their credit card. Their good payment history can help boost your score. Just make sure they actually have good credit and pay on time. Action 6. Pay more than the minimum payment. If you're carrying credit card debt and only paying the minimum, you'll stay in debt forever and pay thousands in interest. Pay as much as you possibly can each month. Even an extra $20 or $50 makes a difference. These 6 actions, done consistently, can transform your credit score in 6 to 12 months. Before we wrap up, let me tell you the biggest mistakes people make with credit scores. Avoid these at all costs. Mistake number 1. Ignoring bills. Even one missed payment can drop your score by 100 points. Always pay on time. No exceptions. Mistake number 2. Maxing out credit cards. Using 100% of your credit limit makes you look desperate and risky. Keep it under 30%. Mistake number 3. Closing old credit cards. This shortens your credit history and can hurt your score. Keep them open. Mistake number 4. Only paying the minimum payment. You'll stay in debt forever and pay tons of interest. Pay as much as you can. Mistake number 5. Not checking your credit report. You might have errors that are hurting your score without you even knowing. Check it at least once a year. Avoid these 5 mistakes, and you're already ahead of most people. Alright, everyone, let's wrap this up with a quick recap. Here's everything you need to remember. Your credit score is a number between 300 and 850 that shows how trustworthy you are with money. The higher the number, the better. It affects your ability to get loans, rent apartments, get credit cards, insurance rates, and even job opportunities. The 5 main factors are: 1. Payment history 35%. Pay on time, always. 2. Credit utilization 30%. Keep it below 30%. 3. Credit history length 15%. Keep accounts open long term. 4. Credit mix 10%. Have different types of credit. 5. New credit 10%. Don't apply too often. A good credit score can save you tens of thousands, even hundreds of thousands of dollars over your lifetime. We saw that mortgage example, almost $150,000 difference just from your credit score. Building credit takes time, but destroying it happens fast. So be careful and be consistent. Starting today, commit to these actions. Set up automatic payments so you never miss a due date. Check your credit utilization and get it below 30%. Check your free credit report at annualcreditreport.com. and never miss a payment from today forward. Remember, your credit score is like your financial reputation. It takes years to build, but it can be damaged in minutes. Treat it with respect, and it will save you thousands of dollars throughout your life. Thanks so much for watching. If this video helped you understand credit scores and how they affect your money, please give it a thumbs up and hit that subscribe button. I'm on a mission to teach simple, beginner-friendly finance tips that schools never taught us, and I post new videos every week. Drop a comment below and tell me, what's your biggest question about credit scores? What else do you want to learn about? I read every single comment and I'll answer your questions or even make a follow-up video. And hey, if you found this helpful, share it with a friend or family member who needs to hear this. Let's help each other build better financial futures. That's it for today. Thanks for watching, and remember, your financial future starts with the choices you make today.